All right, why don't we go ahead and get started? So, thank you very much for joining. We're going to talk about emerging markets today. But first, we obviously have to go through our little disclaimer. So, anything you hear today is general advice. Don't know anything about you, so I can't offer personal advice, but would like questions and comments about our topic, or any topic, I guess, but our topic of the day, emerging markets. So, lots of charts today, and just me talking. So hopefully that's okay. All right. So if you've been reading the financial press and hearing from a lot of investors, they are looking at emerging markets and saying they are a great opportunity right now. And over time, I feel like one of the things I've heard is that it's always been said that emerging markets are great opportunities. And really what the driver is of people looking at it right now and saying that emerging markets are attractive. And I think historically, what people have talked about is kind of three different things. So number one, higher growth, meaning that the countries that fall into the emerging market category, and we'll talk about what those are in a second, have faster economic growth than what you're getting in a lot of the developed markets. The other thing you, of course, hear all the time is that valuations are cheaper. So valuations are cheaper in emerging markets than they are in developed markets. And then people always tout the benefit of diversification. So we're going to go through, after a little bit of an overview, on what emerging markets are, and we're going to look at each one of those. So hopefully this will inform you whether emerging markets are something that you want to include in your portfolio, and whether they're a good opportunity right now. So that's the plan, at least. All right. What are emerging markets? So, like anything investing, it's really important to understand what you are actually looking at when you start hearing these terms like emerging markets. And, one thing I will say is that, in my view at least, emerging markets, and when we define investment universes, no matter what that is, we define investment universes. It's really important to go back and look at what are the indexes that have been created and how are those indexes governed in order to understand what we're investing in, whether we are doing that passively and we're following the index, or whether we're doing it actively. Because remember, active managers, of course, will use these indexes as a benchmark when they go out there and invest. And I think with emerging markets, when they first came out as an investable opportunity for most people, it's kind of the early 2000s that this happened. And so, of course, this was governed by creating an index. And one of the most popular indexes out there is the MSCI Emerging Market Index. And that's the one we're looking at on this page. And that's the one we'll be talking about today. And really what this was an effort to divide up the world between so-called developed markets and then emerging markets. And then we have some that fall outside of both. So whether we call those frontier markets or potentially countries where you don't necessarily have publicly traded companies, so you can't invest in them. But really what we need to remember is that this was frozen in time when this index was created, and there is no mechanism. The portfolio construction around this index, or the index construction, is really based on market capitalization and the different companies that are within the group of countries that have been defined as emerging markets. And so when I go through this list, I see some markets that I don't necessarily think are emerging anymore, and some that are. So we do have very different countries in all of these. So let's talk about a couple of them. So number one, with emerging markets, you do need to realize that obviously China dominates the index. Now, not to the extent that like the US dominates the developed market index, but you are putting about 30% of the investment into China. And that's a big enough chunk that even for active managers, really a driver of their returns is, are they overweight or are they underweight China? And then, of course, how does China do relative to the other countries in there? So you see a big chunk in China. Taiwan, number two. Now, Taiwan, interestingly enough, is very much driven by this Taiwan Semiconductor, obviously a famous global company that's the biggest holding in that index. So certainly you sort of go through here and look at these countries, and they do not, from a GDP perspective, their weighting is not based on that. Remember, it's only market capitalization that's driving that weighting. So I think many people, Taiwan, a relatively small country, people would probably be surprised it makes up so much of the index, but there we go. You know, sectors at the end of the day, financials, information technology are the big ones. That information technology is driven by some of these giant Chinese technology holdings that we're seeing on here. But that's the sector breakdown. Okay, good question by Scott. Scott says the U.S. is currently actively campaigning to change the status of China from developing to develop for the purposes of international agreements, World Trade Organization, et cetera. If this is successful, will S&P follow this change definition of China and add China to the developed market indices, having removed it from the developing emerging market indices? Well, I certainly don't want to speak for any index provider. My guess would be they wouldn't. And I think it really goes back to this notion that we're kind of frozen in time with what developed markets or emerging markets, same thing, just opposite side of the coin. I would doubt that they would do that. I would doubt that they would take China and put it into developed market index, but anything can happen. All I will say is, you know, when you start looking at some of these countries in terms of standard of living, certainly Taiwan, South Korea, and I did a previous presentation looking at the GDP per capita and some of the income per capita in these countries, and certainly Taiwan, Korea, China's not there yet. But if you start comparing that to a lot of the developed markets, they are right there with them, which is very different from some of the countries that I guess are not as far along on that development spectrum. So I would guess no. I would guess they would maintain the index as is. That's keeping those countries in there. But you do have countries that have very different economic realities in this index now. So I think it'd probably be worthwhile if they did that, but I'm guessing that they won't. That would be my guess. And just remember, you know, that would create. They removed China from this index. That would create an enormous amount of, it's not rebalancing, but enormous amount of changes that would have to happen to all sorts of portfolios globally. And it would be very, very difficult to go through. So obviously the indexed investors would have to sell everything in China, and then everything would have to be purchased in a developed market index. So that could potentially deliver a lot of capital gains to people. So that's one thing that happens. But then also all the active managers that follow this strategy that is aligned to these indexes, they would have to go through and do the same thing, right? They basically have to divest themselves of anything that was in China because it would no longer fit that definition of the emerging market index. So my guess is they would not do that because it would cause a lot of problems, but you never know. I've been wrong before, frequently. All right, so let's look at performance. So the interesting thing about emerging markets is, in my view at least, emerging markets haven't done that great, especially over the last 10 years. So we have three different indexes here. All right, we've got, as I said before, the MSCI Emerging Markets Index. So one of the really big ones. We've got the MSCI All World Index. And then we've got this MSCI World Index. So the difference between the two is this ACWI index includes both emerging markets and developed markets. So that is the entire investment universe. And then if we look at just this world index, this is only developed markets in it. So just so we understand where we are, we can see over the last 10 years, emerging markets have underperformed. Same thing with 5 years, same thing with 3 years, same thing year to date and 1 year. So we have seen a lot of underperformance. And, I think we obviously should not make decisions on investments based on recent performance, but we do need to think about some of the factors that have influenced that. That's kind of what we're going to do today. So I did just want to throw this up there so that people can see that emerging markets have not performed great, specifically over the last 10 years. But we can think about the potential that people see around emerging markets and how that fits in to the potential investment opportunities. Because I will say a lot of people are talking about emerging markets. And I think a lot of people are talking about emerging markets, and this doesn't even capture it this 1 year, but even if you go back and look at 2022, they did pretty terribly. So naturally, that's a good place to look when markets have not done well, because there are potential opportunities there. So that's a little bit of a performance. Good question by Lisa. I will get to Lisa's question in a second because I think it's important. So Rodney's saying reversion to the mean, right? So reversion to the mean is a very powerful investing concept. And, basically the notion is that stuff that has not performed well will most likely come back. It's a good place to go look for investment opportunities. Okay, so Daniel says there's an argument that active management works better than passive for emerging markets. In general, Miskey, active versus passive makes a better argument. Well, passive versus active is a better argument for broader big market cap. Okay, so let's talk about this very quickly. And what Daniel is pointing out is that when we think about active and passive management, what we really are looking for, and history would suggest that active management works a lot better in markets that are less efficient. And when we say less efficient, what we're talking about is a market where values reflect prices less frequently. And there's lots of different ways to talk about efficiency, but one very big thing about efficiency is, number one, how many people are interested in it. And it's the point that Daniel's making. He's saying that passive is better than active in broader big market cap, right? So if we have a developed market and large stocks in a developed market that's very closely followed, so let's call this US S&P 500, or in Australia, the ASX 200, we've got a lot of investors, professional and otherwise, focused on a certain market. When there aren't a lot of reasons that investors can't access that market. And there are investors who cannot invest in emerging markets because there's more volatility, which we'll talk about. So certainly there's a lot of investors who can't invest in small caps, so small companies, because they just have too much money, right? So if you have so much money, you go out and buy a small cap, it's not going to really impact your returns at all. So there's a lot of reasons why these markets that are excluded from a lot of investors, where investors don't pay enough attention, are less efficient. And less efficient, remember, prices and values do not reflect each other as much in a less efficient market. It means that active managers should be able to outperform. So there should be bigger differences between price and value that they can take advantage of. The other thing that I would say about emerging markets is when we're looking at active versus passive, what we want to look at is the investable universe versus how much of that an index makes up. So yes, an active investor does need to use an index to govern what they do, and they will do that. But just remember, you've got all these different countries. You've got a lot of countries that have that the markets are less under investor, or investors pay less attention to those markets. So there's more opportunities to go out there and find things. So yes, I would say that emerging markets certainly do lend themselves, given that argument, to active management. So that is, yes, that is something important. So Pete says, is there a currency factor to consider in these index performance numbers? Yeah, absolutely. So anytime that you're investing globally, currency matters. It's going to contribute to or detract from returns. So remember, when we are looking at emerging markets, we are not looking at them with local currency. We are looking at them in whatever currency, in our case, the Australian dollar. So just remember that is always a factor. And, I will say that kind of in general, one thing that's hurt the returns of emerging markets, particularly in the performance chart that I'm showing here, is that the US dollar has done very well in general over the last decade. So something to consider. All right, so let's look at valuations and risk. So this is that same performance. Oh, I screwed this slide up. Yes. All right, we'll ignore this first part. I deleted the wrong thing off of here, but I will go back and find it. So let's look at valuations and risk as soon as, what have I done here? Okay, just ignore me. I know that's hard since you're watching me on a webinar. All right, so let's talk about risk and return characteristics. So one thing that we do need to be very cognizant of with emerging markets is that from a risk perspective, you are going to get a lot more volatility. So remember, that's the way we measure risk as an investor. Now, that's not the way that necessarily you should measure risk, but that's the way the industry looks at risk. So basically, things that bounce around more, that are more volatile, we say are riskier. And you can see that emerging markets, and we'll sort of walk through this, you can see that emerging markets are more volatile. So in this case, we're looking at these same three indexes. First thing we're looking at is standard deviation. So standard deviation is a measure of the dispersion of returns around the average. So very simply, the higher a standard deviation is, the higher the dispersion of returns around that average return actually is. So that means it's more volatile. So it's one measure of volatility. And really what we want to do with standard deviation is, yes, it's interesting to look at some of the numbers, but we do want to look at higher is worse, means it bounces around more. But the one thing I would say about volatility is remember that how much something bounces around, if you're a long-term investor, should matter to you less, unless it is causing you to make poor investment decisions, as in that volatility is driving you to freak out and sell, or when the market's doing really well, it's driving you to put all your money in at the top. But as long as we're able to resist those behavioral urges that market volatility signals, then it doesn't really matter over the long term. But you can see that the market is more volatile, and then we can see the maximum drawdown. So basically the maximum drawdown, and they've got the periods of time, which are all pretty similar. That is how far from top to bottom that the market fell. So you can see here about 7% more than this overall developed and emerging market index. And then, a little bit more over this MSCI World Index. So you see you are getting larger drawdowns, at least from a maximum perspective. All right. The big question, and every single thing that I ever see about emerging markets talks about growth, economic growth. And it's in every single pitch that an emerging market portfolio manager will make, or any pitch around a passively managed fund. It will say that these are the parts of the world that are growing faster, their economies are growing faster, and that's a reason to invest. The question is, and we'll spend some time looking at this, the question is, does economic growth translate into share market returns? And we'll use China as an example. And I think China is a good example because, of course, China is the largest part of this index. But then we can talk kind of theoretical around this happens. So since the year 2000, Chinese annual average GDP growth rate has been 8.67%. Now, it has slowed recently. So if we go back and we look at the annual numbers, it's certainly been coming down, but that means it was growing even faster earlier. So we've had incredible economic growth in China in terms of GDP. And I just put Australia down here in the same time period as a comparison. Oh no, went to the wrong side. So Australia less than 3% since 2000. So I think a lot of people would sit there and say, okay, well, China must have been a better investment opportunity. The economy is growing so fast that that must be a great place to put your money. versus Australia, which is growing a lot slower. And Australia is largely indicative. I could have picked any developed market. So whether that's the US, whether it's countries in Europe, I could have picked any developed market and we would have seen the same thing. China has significantly outgrown those markets. But then we can sit here and we can look at an index of China shares. And we can see that, yes, outperformed emerging markets over 10 years. Even we go back to inception, significantly underperformed what we got from other indexes. And remember, all of these indexes, these three indexes, all include emerging markets in it. It would even be a bigger outperformance if I put the US on here, if I put Australia on here, if I put just developed markets on here, that outperformance would have been even more significant. So why is China, and I could use all sorts of different countries or emerging markets in general, why are we not seeing investment returns from growth? Well, there's a lot of reasons for that, but we need to remember what GDP is. So GDP is supposed to represent the entire economy. The entire economy, of course, does not really have anything to do with the stock market. Depending upon the country, the stock market can make up a lot of the total economy or very little of the total economy. So in a case where you had a lot of government ownership of companies, then of course that growth may not actually flow to the companies that are publicly traded. So that's one thing we need to look at. We also need to look at, of course, is where's that economic pie going, right? The other thing we need to look at is with GDP is the fact that the overall economy growing doesn't necessarily translate, even for that share that goes to companies that are publicly traded, doesn't necessarily translate into profits that come to us as the owners of those companies, right? So very simply, we can think of all sorts of different factors that go into this, but taxes is a simple one. So what do we want as investors? Well, we want low taxes on company profits, because the lower the taxes are, the more money flows to us. So remember, GDP is a very top level number. What we're concerned about as investors, our top level number is revenue. We're concerned with what comes out the other side. We're concerned with the share of GDP that goes to corporations. Now, if you look at the US, for example, which is a good one to compare to China, over the past 20 years, US corporate profits have made up a bigger and bigger and bigger part of GDP. And, there's a lot of people that are very upset about that. But as investors, it's a good thing for us, right? If we own those companies. And why is that? Well, corporate taxes have come down, kind of most recently with Trump's corporate tax cuts a couple of years ago. So corporate taxes have come down, profit margins have gone up. So a lot of this has been from becoming more efficient. So whether that's offshoring and outsourcing and just making sure that production is actually cheaper, we've seen a lot of that as well. So corporate profits in the US have grown to a bigger and bigger part of GDP. Then we have to look at a country like China, and this is not a criticism of China, but it is a very different economic system, and there certainly is, I would argue, a larger political component to how the economy is run. I think there's probably, to be fair, maybe more of an emphasis on making sure that it's not just corporations that benefit from what's happening, but it's also everyone. Obviously, a lot of focus on employment, a lot of focus on, ensuring that the Communist Party in China remains in power, and making sure that there are lots of people that are sharing from economic growth in China, where there's more of a sort of shareholder focus in the US. So once again, I'm not saying anything's good or bad, but we do need to look at the political system in certain countries as well and figure out if that is something that's going to impact returns. So does economic growth translate in share market returns? Well, there's not a lot of evidence that it actually does, particularly when we measure that with GDP. So let's look at profit margin. So remember, when we look at profit margin, we are looking at, we've got the top line for companies, revenue, And then we have what flows to shareholders at the bottom. What are the profits? So when we're looking at margin, we're just dividing the two, right? So how much of every dollar in sales that a company makes do they keep at the end? And that's the money for us as shareholders. That's money that can be reinvested back in the company. That's the money that can be used to pay out dividends. That's what we're really interested in. So what we've got here, now these are forward profit margins. Remember, we've got certainly the historic ones on here. So what you can see is, for those of you that are better at colors than me, we've got the US at the top, and we can go back historically and see what that profit margin is. EMU, so that is just the EU. So those are countries in Europe. We have emerging markets, we have the US, and we have all countries, world ex-US. What you can see is emerging markets are at the bottom of this. And just so, and Australia wasn't on here, but here's Australia. So Australia is actually higher in terms of forward profit margin, 15.2. So more than anything on here, including the US. So that's going to be another huge driver, those profit margins, and certainly changes in those profit margins over time. Really what we want in companies that we invest in, or countries we invest in, is we want those profit margins to keep going up, because that's great. They're selling the same amount of goods and services, and we get to keep more. So that's one thing that we need to look at, and especially the fact that emerging markets is less than half of Australia. Remember, Australia's at 15.2. So that's something that's very important as well. So even when people sit there and they talk about growth, two things we need to be concerned about is how much of that growth goes into publicly traded companies. How much can they take advantage of that growth? And then the other thing is, how much do they get to keep? So, and there are all sorts of reasons why emerging markets have lower profit margins. And it can be from everything from the fact of what businesses they're in. So if we think about kind of traditionally how, where a lot of economic growth came from in China, well, a lot of it was manufacturing. A lot of it was sort of offshore manufacturing from companies, and those translated into exports. Now, generally, and this is a generalization, and I think things are changing, but generally, if we go back and look at that period from 2000 on, and we'll use Apple as an example. So Apple makes a lot of their iPhones in China. They don't make them themselves. They're contracted out. They're trying to diversify where they make them now. But who do you want to be in that iPhone? We think about the whole, just the whole life cycle of an iPhone. Who do you want to be? Do you want to be Apple, who's created a brand and is selling services and everything else onto that iPhone? Or do you want to be the company that's actually making it? Well, you want to be Apple. Right? In terms of profit margins, who's making all the profits? Apple is. So that doesn't mean it's not profitable for these companies to make iPhones, but the margins are a lot thinner than what Apple is doing. So it's really their brand and their technology and their design that is allowing them to slap these huge markups on an iPhone. And then, of course, they sell services into it. So who do you want to be in that kind of value chain for an iPhone? Well, you want to be Apple. And so part of it is just this lower profit margin. Part of it is, okay, what are the goods and services that are being created in these countries in the emerging markets? A lot of it has to do with tax as well. A lot of it has to do with how much workers are paid relative to what the company is making. So there's all sorts of things that impact how profitable a company is. So it's important to look at those factors. And if we go in and we look at emerging markets, so this is profit margins of a selected amount of emerging market countries, and you can see who's at the bottom: China. It's only 4.7%. So they are actually dragging down. Remember, emerging markets overall were higher at 7%, but this is the largest component of emerging markets. So we do need to consider this. So they're actually dragging down that forward profit margin. So another consideration that we have there. So just remember, somebody tells you that there's a lot of growth, spend some time thinking about how that growth translates into good outcomes for you. All right, let's spend a minute on diversification, and then I can sort of talk through. I'll talk through because I accidentally deleted the wrong thing off the slide. I'll talk through valuation levels as well. So I took this quote, and I could have taken a quote from thousands of different places about diversification and emerging markets. So I got this one from Conventional Fund Advisors. So you guys can obviously read this yourself, but basically what it's saying is that emerging markets do not move in lockstep with developed markets. So the advantage, of course, is that if we have a huge pullback in developed markets, then hopefully emerging markets will smooth out those returns in our portfolio. Question I would have, and this is in a way diversification. The question would be, is this really the type of diversification you are looking for? So if you are, then emerging markets could be a really good opportunity for you. And let's go through a scenario where you would be, and a scenario where this maybe isn't the type of diversification you're looking for. So when would you want this? When would you want to hold a portfolio with different assets where some go up in some periods of time and some when others are going down? When smoothing out, so basically what that's doing is it's almost hedging your portfolio, not hedging it in any sort of like traditional sense, but it is in a way smoothing out those returns, just lowering the volatility of your overall portfolio. Well, one time you would really want to do this is if you are approaching retirement or in retirement, right? So a situation where every year, certainly in retirement, and you're getting ready for this approaching retirement, every year you are pulling money out of your portfolio. And you want less volatility in your overall portfolio in those situations, because every year you have to sell something. If you're 30 and you're investing for retirement, you're not selling anything for potentially 35 years, right? So you don't really care at the end of the day around this type of diversification. You don't really care the correlation between returns and different assets, but you certainly do care if you are moving into retirement or in retirement. So this is a situation where even though over the last decade, emerging markets have not done well, if you go and look at year by year performance, you do see that they're not very correlated to developed markets, where a lot of other markets are very correlated. Right. So if you go back and you look at like Australia and the US, they're pretty correlated, right? Even on a daily basis, sort of wake up and you see how markets did in the US overnight, more times than not, that's also going to drive Australian performance. So there are some exceptions, like last year, for example, where Australia did much better. But think about whether this uncorrelated assets in your portfolio, think about if that's something that matters, because that is going to really impact diversification. All right, so let me see. In terms of, sorry, now you have to look at me for a second because I deleted something out of here. I'm just trying to go to, okay, so I'll share my screen again. So this is just from a MSCI emerging market fact sheet, if I can figure out how to do this. So this is the part that I accidentally deleted off of my slides. And this is where you'll see I got a lot of this information. Now, right here, this kind of fundamentals piece, May 31st, 2023, we can see emerging markets. So once again, this is the same. Sorry, I zoomed out too much. So once again, we have emerging markets versus this everything versus the developed market. And what we can see in terms of fundamentals is we do see that emerging markets are significantly cheaper than other markets that we're looking at, the same comparison, see that they are cheaper. And that is a good thing in general. So remember, valuation levels really matter. So higher valuation levels generally mean that returns going forward are going to be lower because you don't have that opportunity to get that valuation kick, right? So basically, if we look at the source of returns, changes in valuation levels matter a lot. So if valuations are really expensive, it's less likely that you're going to see increases in valuation as you go along. So that is in general. The one thing I would say that's important about emerging markets and something that investors do need to decide is that when people come out and they say emerging markets are cheap, you need in your head to figure out, are they going to get uncheap? So really, Emily's rolling her eyes. I don't think she liked that uncheap word. So really what you're trying to look at is, okay, I can see here, under 13 from a price earnings perspective. We look at developed markets that are over 19. If these never change, if developed markets continue to trade at 19 times earnings forever, and emerging markets continue to trade at 13 times, a little less than 13 times earnings, and you never see changes in those valuation levels, then it doesn't really matter if it's cheap, right? We like to look at things that are cheap that then hopefully get more expensive, because that is the way, if we own those securities right then, that is where we get that kicker into the returns, right? So that is, I will read Lisa's comment in a second, but it was very funny. So that's really what we need to decide. Are emerging markets ever going to trade for valuation levels that are higher on a relative sense than developed markets? So it's just something to think about, that when people come out there and say something is cheap, there could be a reason it's cheap. What are the reasons it could be cheap? Well, one reason could be because the profit margins are lower. Another reason that it's cheap is because there's more volatility and investors don't like that. Another reason that it's cheap is there's a lot of investors who can't invest in emerging markets. So if you don't have as big of a capital base going in there, then that can cause problems. So just another thing to consider when you're thinking about emerging markets. Okay, so we got some questions and funny comments from Lisa. So she says, uncheap is when a small bird regrets what it just said. Not any bird, just a small bird. So Daniel says, yep, this is why I hold emerging markets, diversification. Yep, so if this is something that you are looking for, Daniel says, what's your investment time frame for MSCI? The ones I was showing, I've got a 15-year time frame on my managed fund on the basis my fund manager keeps doing a good job. He says, excuse my typing, I'm walking home and listening on my phone, multitasking. He says, GDP is a horrible measure for company returns. I agree. Completely, but I think that a lot of people, when a lot of people talk about growth, what they're looking at is they're looking at overall economic growth, which we mostly use GDP to measure. All right, so we've got a question. Does statistics taking into account movements of companies from emerging markets to developed? I believe capital all the time will be flowing from one to the other. Okay, so very simply, companies cannot move from a developed market index into an emerging market index. And the reason for that, and this is a kind of dumb and antiquated way of looking at companies, but we put companies into whatever country that they are based in. Right. So very simply, we can sit there and we can say, okay, Fortescue is an Australian company. And yes, Fortescue is based in Australia. But we had an article that came out today. Fortescue, for example, is the most exposed company in Australia to China. And it makes sense, right? Even though they've got this whole Fortescue futures industry thing that hasn't done anything yet, they have one commodity. They're not diversified like BHP. They've got iron ore. China buys most of the iron ore. Fortescue sells vast majority of their iron ore to China. So that's an Australian company. right? But it's also a company that is almost completely exposed to China. But remember, that's an Australian company. When we look at emerging markets, that yes, these companies cannot move. So Taiwan Semiconductor will forever be an emerging market company, no matter where they sell their chips, no matter where they manufacture their chips. They're starting to diversify a lot now, including building some big plants in the US. They will always be an emerging market company. So you can't move from one to the other. But if we're looking at individual companies we want to buy, we want to be very cognizant of what are those factors that are going to influence that company base. So they're stuck there unless they make some sort of decision around the index, like we talked about before, where they take China and move it into developed markets. So they are stuck there for now. So we do need to be aware of that. The one other thing that I would say, given that Australia example, so if we go back and we look at GDP growth in China, remember that 8.67% since 2000, who has benefited from that? Well, in a lot of ways, Australia's benefited from that, right? So the best China play, and don't quote me on this, maybe there was a better one, but the best way to take advantage of the economic growth in China was probably to own miners in Australia. Right. So at the end of the day, GDP growth in itself, we don't really know where that flows, where the investing opportunities are there. But I think one would argue if you go back in time and go back to 2000, it was buying Australian miners was the way to benefit, not Chinese companies, but Australian miners. So something to think about as well. All right. So we've got a couple of questions. So Lisa says, are there still a lot of Chinese companies owned by the government impacting investor returns? Yeah, I'd say absolutely. I'd say two things. That the companies in China, and this is a little bit of an opinion, but companies in China are more influenced by things that the government wants them to do than companies in developed markets. Now, once again, that's an opinion, but it does seem like there's a lot more influence. It's either direct influence because the Chinese government or a state-owned bank, either the Chinese government owns part of the company, a state-owned bank, it's lending them the money that they need to continue operations. There does appear to be a lot more influence that the government has on those companies. And I would say the government, once again, this is not it's not an indictment of this thinking, but I would say the government's concerned with more things than shareholder returns, and that they are trying to do other things from a policy perspective with how those companies act. And we did see that. One of the big drops in emerging markets was really around the crackdown on tech companies in China. So, something to think about that. From a policy perspective, the government decided that these companies did need to be brought under control a little bit. And hey, they did it. Market plunged. Emerging markets as a whole in China did not do well. So that's why we're always thinking about those geopolitical risks and factors that go into different investments in different countries. It's a good question, Lisa. Answer the currency one. So Lisa says, is the term emerging market a slightly confusing moniker, not necessarily descriptive of the countries included? I would say absolutely. Even if we go and we sit there and rank countries on however we want to define them. So generally it's like a per capita income type of look that we do. There are wild differences between countries that are in emerging markets. So as I said, I talked about South Korea, I talked about Taiwan, Israel. There are countries that have very high standards of living, and that in every sense of the word would fit the definition of a developed market that still sit in these indexes. Whereas, and I don't think this is a derogatory thing to say, there are countries in Europe, and the one that just kind of sprung to mind is Greece, has obviously gone through a lot of economic issues, where you sit there and you look at stuff like per capita income and things like that, and you think, how is this a developed market when we sit there and look at Taiwan and South Korea, countries like that? So yeah, I would say, Lisa, the definition is a little bit it's a little bit loose. So remember, you kind of got to remove yourself from your viewpoint of the world and just sit there and put your investing hat on, saying, what's a emerging market? Well, it's what the index providers tell us is an emerging market. I was about to give up on emerging markets after more than 30 minutes of not so impressive data. Yeah, maybe I spun this whole thing in a certain direction, but I will say part of it is just because there's such a almost like consensus out there, and we saw a lot of this around China as well, that these are great investment opportunities. So you can go read about why they're great investment opportunities, but just remember, past these kind of headlines that people come up with, see if all of that plays out into what you're looking for as an investor, and that is returns. All right. I promised Emily we would finish early, and it looks like we have, although we have a question. Rodney says definition not based on status of these countries today, but when the index was made 20 plus years ago. Yeah, absolutely. We are stuck in the past, more ways than one. All right. So we're going to finish early because Emily gets to meet with me now, which is her favorite activity. She looks very excited. But anyway, thank you very much for joining. I hope that everyone who had a long weekend had a great long weekend. And yeah, send me an email if you have any questions.
This video has been prepared for clients of Morningstar Australasia Proprietary Limited and or New Zealand wholesale clients of Morningstar Research Limited. Any general advice has been provided without reference to your financial objectives, situation, or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.